There's no value in technology, there's no value in finance, there's no value in entrepreneurship if it's not grounded on proper human foundations.
Paolo Sironi is the global research leader in banking and financial markets at the IBM Institute for Business Value.
One of the things that I love from your book of 2021 is Banks and Fintech and Platform Economies, is the concept of platform economies.
There is a very big difference in the way platform economies work in financial services compared to how they would work in other parts of the economy like e-commerce. And I don't hear this from policymakers, and big entrepreneurs or large conferences. I hear the usual talk. They talk of money, they talk of power, but not the talk of value. How can we build a value-based capitalism that allows people to position freely in the market while protecting the weakest link, which is the final retail client or the final consumer?
Want to be a part of something bigger? By subscribing, you're not just getting access to incredible content, you're joining a community of like-minded people who are passionate about innovation, technology, and business. Hit subscribe now, and let's build something amazing together. Welcome to the family. Hello and welcome to Dinis Guarda YouTube podcast show. Once again powered by citiesabc.com, businessabc.net, and wisdomia.ai. We keep profiling the global leaders, the thought leaders, and the people making a change in the world. That is more and more, I would say, disrupted and inspired by technologies, by artificial intelligence, by a lot of different things. But especially what we celebrate in this series and profile is the doers. Today, I'm particularly excited to welcome Paolo Sironi, a global personality and best-selling author, podcaster, board advisor, and international speaker with over 2 decades of experience in the financial and fintech industries. Paolo Sironi is the global research leader in banking and financial markets at the IBM Institute for Business Value. He leads IBM's global research efforts in banking, providing strategic insights to major financial institutions worldwide. His work focuses on business model transformation, advising C-level executives on leveraging technology for competitive advantage and sustainable growth. Prior to this, he was the head of portfolio strategy at IBM Risk Analytics, where he led innovation and identified new trends in risk management. He also founded CAPITECTS, a joint venture startup focused on outsourcing risk technology and providing innovative cloud-based services in wealth management and investment management. Paolo was also the director of risk management at Intesa Sanpaolo, where he created the market and counterparty risk management operations and obtained Italy's first regulatory approval of internal models. Paolo is among the most respected fintech voices worldwide and has over 25 years of experience in the financial services industry. He hosts the international podcast The Banker's Bookshelf, where he interviews authors and researchers of the field's most exciting books, papers, and publications. Paolo also co-hosts the Breaking Banks podcast, a monthly show produced by the Breaking Banks platform, Provoke Media. Paolo Sironi is also a keynote speaker who connects finance and technology through strategic innovation. He covers topics such as fintech, wealth management, risk management, and the future of banking on platform economies. He is a best-selling published author with books that have been recognized as a top seller in finance and technology fields on Amazon.
Paolo Sironi, you are one of the most fascinating personalities in the financial world, and as well a person that I know for a lot of years. But one of the things I love about you is your energy and passion, both for research, for companies, for banking, for finance, for fintech, and as well the energy we put on that in both energy, physical and intellectual. So I would like to start with your beginning. So, Paolo, if I would go back at your, teenage years or university years, and you have a lot of education, what made you a bit the person you are here, and especially that passion that you have for research, for finance, and for putting all of this fantastic research together?
Liz, first of all, thanks for the friendship. I truly value it. And and I'm happy to be here talking to your audience as well. And I think that a couple of things we want to say. First of all, how can I synthesize my career journey, which is actually a research journey? I like to think that it's like the Divine Comedy of Dante Alighieri, the Sommo poet in Italy. He basically went through a very complex journey from hell through purgatory into heaven. So hell, I like to think, is when I was a quantitative risk manager in banking. I love banking, I love risk management, but I really saw all the sins of the systems and the banking systems, and also those that you haven't seen, I know them. And then I decided to create a fintech in Germany in 2008. And you know, entrepreneurship is like purgatory. You slap left and right because you want to make it happen. You have to repent yourself. But it's an amazing experience. And then IBM bought CAPITECTS in 2013. So I joined IBM, and you know, the heaven of exponential technologies, that's what it is about today, is on everybody's mouth, the fact that technology is advances so fast. But in the end, through this journey, I kept a constant, which is the most important thing. I tried to understand the human being. Okay, so there's no value in technology, there's no value in finance, there's no value in entrepreneurship if it's not grounded on proper human foundations, which are not just abstract ethics, is an understanding of how people deal with technology. So now, what motivated me in keeping this perspective throughout my career journey as a research backbone? Well, two things. When I graduated in 1994 at the Università Cattolica in Milano, I majored in banking and financial markets, and I graduated with full marks, 110 lode, we say in Italy. But I remember that the main textbook I used, that was the one that my professor published, opened with 20 pages discussion about the asymmetry of information in financial services. And I have to confess that I did not understand it. And it took me a while to research about the reasons why I did not understand it. And the thing was very simple. It was not explained correctly. So it was wrong. Okay, so the asymmetry of information is what effectively shapes the revenue mechanism in financial services. In abstract terms, we may believe that someone knows less than someone else. And that's not true. Like, it is fair to say that in the ivory tower of capital markets, there may be some traders that are price makers. So de facto, there may be more others which are price takers, so they have to follow. But all in all, the whole industry is based upon serving individuals and families. And in that context, it happens that few people pretend to know too much about the future, and they know nothing about the future because the future is open. No one can predict the market. And the majority of people are scared not to know anything about the future, but they should know enough to be cautious. And now it is the make believe of the asymmetry of information, that somebody knows more than somebody else, that shapes the way trust is forged in financial services and the way people make decisions. And that's a very important element because the information element is pervasive in everything that is happening today, because information technology is becoming really about sharing information. But data is never complete. Nobody really knows, the future and the present in full. So by starting from this perspective, you understand that the power, but also the limit of technology, and how to really transform the essence of financial markets, knowing that, yes, we are just playing this make-believe. And the second element I shared my research was the financial crisis in 2008. So now I'm graduated. I've been working for almost 15 years as head of quantitative risk management. And the system collapsed. And I remember there was a speech by Alan Greenspan at the Senate committee in the United States of America, where the commission that wanted to understand the source of the financial crisis asked him for a speech, and the head of the commission asked him, why is this happening? And Alan Greenspan, the former chairman of the Fed, said, well, I found a flaw in the model. And the chairman of the committee goes, you mean you found the flaw in reality? And Greenspan goes, no, 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 no. He goes, what is the model? The model is a conceptualization of reality. We believed for many years that financial institutions are rational and markets can be efficient. And I came to realize that this is not true. And the concerning thing he said is that they seem to work for 30, 40 years, doesn't work anymore, and I know what to do about that. Now, remember that Alan Greenspan is at the origin of what we now call quantitative easing or the systemic put, largely speaking. So basically the fact that the central bank intervenes somehow to save the economy and the market, and in particular financial markets. So there was a moment of radical candor where he basically said, what I did so far maybe was not correct because the foundations were not good. So if you read my literature, and I know that many had the opportunity to do so, and I thank them for the time they invested in reading my work, you realize that these are the two elements, the two big questions that I want to address. So how to realign the concept of the asymmetry of information in terms of generating value for clients, and how to fix the fault of the model in a way that through positive theory we can redesign business models for financial institutions that are based on stronger foundations, so that we will not face another crisis like the one we faced in 2008. And let me say, the foundations hasn't been reset after that, so we might be facing it again.
So you have a career that spans around 25 years, and in your career, you've been touching all the areas of finance and technology. You just mentioned a couple of things in terms of your background, but as well, a lot of relationships between the traditional banking and the technology world and the evolution that has been between the two. But as well, you always did it with the component of research and the component of scientific approach, as well, a bit academic, but as well, always putting together, which is very important. So if you look at 25 years, there's a massive evolution on the financial industry. Although the financial industry, to be fair, was always far ahead than society, because of course it's about money. But if you look at the last 25 years, what would be your highlights in terms of the context of our financial markets?
Well, I would say that if you understand the asymmetry of information, you understand how technology tries to transform financial services and where it succeeded, so also where it did not yet. So the constant that I found, unfortunately, and hope that I can contribute to change that, is that many people did not believe the essence of digital technology. Let's say the digital technology started from 2008, means mobile technology, okay, this phone that I have in my hands. Now, here is the key message. The mobile is a technology of the demand. What it means? It means that you don't go on Amazon to see what happens. You go on Amazon because you want to buy one of my books. Then Amazon might go, Paolo Sironi, IBM, sell mainframe. But essentially, you go there with a specific task, with a specific goal in mind. But most of the revenues that matter in financial services, and they're becoming more and more relevant, are operated inside an offer-oriented ecosystem. So essentially, a bank or most banks are an offer-oriented institution that wants to land on a demand-driven technology. The two things don't necessarily go together. So understanding these elements is foundational to understand how technology can transform the mechanics by which financial institutions can be successful in intermediating with the customers. So by understanding that, you see what has been happening in the last, I would at least at least I would say 15 years of fintech innovation. If a bank is or a financial institution is the combination of four major entities, one doing payments, one doing credit, one doing investments, and one doing insurance, you see that payment is the most symmetrical part of the business. People can pool. They're capable of, using digital to do something in a fairly self-sufficient way because the symmetry is pretty low. The symmetry of information is a function of how much uncertainty is inside the system in that make-believe I mentioned before at the beginning of our conversation. So there's no surprise that the largest unicorn in fintech occurred in payments and started from there because they could scale on volume while margins were commoditizing. The next to payment in terms of the asymmetry of information is credit, which is still pretty low in terms of asymmetry of information because in many cases you can get free money, put it this way, right? So if you use unsecured loans to onboard customers on a digital solution, it means you give money like sort of for free. Okay, let's move it to the extreme. So don't surprise that people come, right, and onboard themselves. The problem, however, is that you need to master the credit risk recycle, which is what Marcos from Goldman Sachs was not capable of doing. So they misunderstood basically the mechanics at play inside their app. But so payment and credit are the more symmetrical, where the uncertainty that you deal with as a client, because you get the convenience of paying or you get the money coming to your account, dictates the fact that you can pull from digital. So pay tech and credit tech could grow faster than other aspects of banking. But then you have investing, where you are sending me money because I will invest the money for you. So your brain somehow tells you, hey, watch out. Are you sure that Paolo Sironi understands finance? Because I know that he works for IBM, so you have to explain them as we just did, that I was head of quantitative risk management for 15 years, so I have a fairly grander opinion about the dynamics of financial markets and so on and so forth. So that means that investing starts being more like a push oriented as a consumption mechanism. So if I don't talk to people, I may not be able to make a decision, so I don't transact. And that is the reality of the majority of the retail customers out there where banks wants to intermediate with. So now, higher fundamental uncertainty, you have to deal with in the decision, higher asymmetry of information, more complex to digitalize. So the robo-advisor were not so successful compared to the payment companies. So, wealth tech is more constrained than pay tech. And the last but not the least is insurance. Insurance is a very varied industry. Some insurance contracts are compulsory, so they're more digitally, if you like, demand oriented. Others instead are still extremely push, like life insurance. So if you have to discuss with somebody the fact that you need life insurance because you might die, you typically want to have the conversation with somebody you trust, with a person, and not ChatGPT. So that means that some aspects of insurance are very hard to digitalize compared to others, and of course, again, compared to credit and compared to pay tech. So then you say, to conclude, that it is the understanding of the pull and push mechanics that intersect human behavior and technology differently from retail markets or e-commerce that dictates what we saw in the last 15 years in terms of success or failure of fintech innovation. And it is only by addressing theoretically and practically this element that everyone using technology to transform financial services can be successful.
Yeah, it's a lot of things there, and effectively, we are in the beginning of a much bigger revolution. But I want to still go for your career before I go to some bigger topics. So let's look at your body of work in terms of publications. You have a substantial amount of books. I'll just, for our audience, of course, these will be all on the whatever people are listening to us, they will be available. So we have Banks and Fintech on Platform Economies, Wiley, November 2021, Financial Market Transparency, Edizione Accademiche Italiana, 2019, MiFID II, Value Generation for Investors, 2018, and Fintech Innovation for Robo-Advisors to Goal-Based Investing and Gamification, 2016, and Modern Portfolio Management for Markowitz to Probabilistic Scenario Optimization, Risk Books, 2015. So and as well, you have always something new coming, and there's a couple more books that I can go for the year. But So from these books, there's a lot of research, and when you do a book, there's always things that. So for our audience, and for people, I'm sure, of course, within the fintech industry, well known, and the banking and finance, but for a bigger audience and for young people listening to us, I have an audience that is young people and then more professional. So it's a bit two verticals, and I like to make this in the two parts. What would be your highlights? And probably talk a bit, not about all of them, but some of the ones that you feel more relevant. And that synthesizes as well your vision. And second, probably where you would like one or two that you would like to put more as an highlight.
Well, they are all connected because they're part of the same research effort where I started from different angles leading into, a similar conclusion or a piece that by combining them together builds the final picture. So the first one is Quantitative Finance. Is a book that I love. Is if you like, the essence of my innovative perspective in my entrepreneurship years, and it's basically about how do we create a framework that enables us to deal with the problem of using quantitative finance to decide investment decision making, not by closing the system. So I've got a closed form formula, something that tells me the truth, but helping me as a human being to relate to the problem through heuristics, so what if analysis. So it is a book that talks about the probabilistics and optimization. But I resolved the optimization problem in the book just because I was told that you got to do that if you want to sell it. But the value really is the framework that allows you to bring quant finance into everybody's life in simple terms by creating scenarios and visualizations that help you to relate to the problem, which you see in a moment is very important because it is by relating to a problem that you become more aware and more conscious about your decisions. So that is in the end a direct link to the conscious banking that I discuss in my latest book, Banks and Fintech or Platform Economies. The second book, Fintech Innovation, is maybe the fanciest of the five. The fintech movement was starting those years, so I tried to make my interpretation of what was happening, and I focus on robo-advisors. The subtitle is From Robo-advisors to Goal-based investing and gamification. So I started highlighting why what I thought was the prevailing mindset in wealth tech was not correct, as technology was not ready to replace individual relationships between people and bankers, which are based on the make-believe or the symmetry of information, therefore how we deal with the fundamental uncertainty. And I think that was, prescient, and that exactly what happened in the market. So robo-advisors had to transform, and the goal-based perspective is the one that tries to basically rebuild narratives that help institutions in an hybrid model to better substantiate the value with the customers. And that the third book is MiFID II, Value Generation for Investors, is about market regulation in the European Union, the MiFID II. But as Europe is where a lot of regulation is forged and it's very demanding regulation, I used to say that MiFID II is like New York. If you make it there, you make it everywhere. So this book has been read by a lot of people around the world, even outside the European Union. And it tries to answer that question, which is the product and fee. The product is a solution that justifies the fee. So what is the value for money? And I asked once if Perrier, the former chairman of Amundi, the largest asset manager in Europe, the 10 largest in the world, the same question on main stage of Paris FinTech Forum. I said, if what is the product and solution that justify the fees? And he said relationship, an element of transparent advisory between the institution and the client. And so at the core of the MiFID II value generation for investors is the understanding that the cornerstone of regulation, or the spirit of regulation in the mind of the Commission, the European Commission, was an element of transparency. Then, of course, regulation is a complex animal, is a compromise with the industry, and is never perfect. But the essence of the MiFID II is, can transparency help to build better relationships? That is, very said, is the core of the intermediation between institutions and the final clients. And then leads into the fourth book. So now that I investigated how to really innovate in quantitative finance through the probabilistics and optimization, what is the essence of the intermediation between institutions and clients, right there where the industry becomes more push and the client is less pull oriented. And also, what is the regulation around that in a way that I can also help regulators to make the proper interpretation of what is at stake. I thought it was time to build a theory. Theories are important because if you don't have a good theory, you don't change your behavior. Now, the shift which is happening in financial services is like you trying to produce electricity using a nuclear plant instead of a carbon plant. Wouldn't you change the theory of physics underneath? Because if you use the classical physics theory, you lead to disaster, right? So I thought that we needed also new theory to lead the way in the way we apply technology to transform financial services. And that is the financial market transparency theory and principles. My fourth book is like an essay, it's 50 pages. I say that consume my brain because I wanted to be very concise. And it is positive theory. Positive theory means that by redefining more reasonable biological macro foundations of financial markets that are a fundamental uncertainty and the irreversibility of time, we can now design new business models that work where the entrepreneurs, the bankers can be paid for their job that at the same time maximize the value for customers. So it's a way more balanced approach. And that is what in practice addresses the two problems that shaped my research curiosity. The fact that the asymmetry of information is a make-believe. So by recognizing that, being radically transparent about that, we know how to deal with it differently. And the fact that there was a flaw in the model that Alan Greenspan identified. And now we have a new business model or a set of business strategies that can lead us out of the conundrum. And as I did all of this, then I thought, okay, now it's time to write banks and fintech on platform economies, contextual banking and conscious banking that leverages the previous literature and research now to shape and to explain in very substantiated and analytical terms, but in accessible ways, what basically is the transformation of financial services, because it is emerging. We are going there a bit at a time. But understanding exactly what happens will allow us to accelerate the transformation, leading immediately or faster to the right way instead of going through steps, making many mistakes, and then facing trouble on the way. And that is, I guess, the reason why the banks and fintech on platform economies all books successful, but it's been the most successful Amazon bestseller for banking books in and out throughout the various quarters. And it is a strategic book that engages CEOs, board programmers, wealth managers, credit officers. Is a book for all who wants to understand what really is going on in banking and financial markets through technology.
No, it's an impressive achievement, and I think you keep pushing the boundaries, but as well, I like that it's always with a bridge between industry, academy, and technology, which is not easy to put all these things together because a lot of the,
It's a research for the ecosystem, right? Everybody needs to be engaged, otherwise it doesn't work.
It's a critical element. So you have a position at IBM where you lead the global research in banking transformation. So tell us about that. And for people that don't know how it works, I think it's always important. IBM, of course, is a major global brand. It used to be the biggest brand in the planet in terms of technology. It still leads a lot of things. So tell us about that and how you're shaping as well that through that.
So currently I'm the global research leader in banking and financial markets for the IBM Institute for Business Value, a lot of words. The Institute for Business Value is the IBM Thought Leadership Center. We've been around for a bit more than 20 years. and it's where we connect the dots between business and technology, knowing that technology sometimes inspires, but definitely is a precondition to transform operations and business models. Whatever is your industry, in my case, focusing on financial services or particularly banking and financial markets. And the type of job I do is I do research, I make global surveys, I talk to clients continuously every week. Some of these conversations are also published in an edited form in what we call the advisory makers. And that enables me to bring to the public an understanding of the transformation of the industry with technology, which is filtered through the eyes and the experience of a variety of clients that come from banking, technology providers, fintech, and particularly the unicorns, so those that made it and are more successful. So that makes the IBM perspective and point of view unique, because it's not just abstract, but it's grounded in real life and what is really going on. And if I can say that, to be very succinct, you can understand the transformation of banking this way with technology. Like 15 years ago, when the financial crisis started, all banks had to restructure their costs. And that is the time when the mobile technology was born, as we know today, like the smartphone. So digitalization outright meant basically changing the foundations, so the architectures of banks, like from total on-prem to cloud services, corresponding to the demise of branches, so the closure of branches, and so lifting, shifting those branches on a mobile app. So it was primarily like digitalization outright, right? So pure technology without really changing many aspects of the intermediation with clients. And then banks realized, of course, that was not enough, so you had to change engagement. So that's when they started investing in personalization, so making the mobile app or the conversation on digital more fine-tuned and personalized. That means investing in machine learning, AI, traditional AI. But even in the case, banks learned that it's not enough to shift the economics from branches and personal relationships into digital apps. Something else needs to happen. And we go now to these recent years because if there's something that generative AI is famous for, is language. So we're getting into a period of investing in communication. So you see, we had the years that are still going of digitalization outright, so the architectures, then the investments in personalization with AI, machine learning, and now investments in all communication aspects with generative AI. But there's something else which is emerging at the time, which is a fourth phase, that is the platformization of financial services. And that means how do you effectively engage with clients inside different industries journey, or how do you, if you're ambitious enough, orchestrate those non-banking industry journeys and making banking embedded into that type of engagement model. So the first phases, which are like always running but different intensity, are digitalization outright, personalization, communication, and growing platformization. And that is basically, how I then shape my research, trying to understand these four elements, how they intersect, and how they change in intensity according to the years, the advancements in technology, the capability of the industry and the fintech ecosystem to understand and to find the most appropriate solution to address the various aspects.
Yeah, it's really very impressive, but as well, what I'm interested in is always bringing to the series is how we can create innovation and talk about innovation, but as well keeping the feet on the ground. So this brings me to one of the question around one of the, I think, key elements in your research, but as well, probably the most important things in the financial industry at large. So the importance of risk management. So we are in a very complex moment because, of course, we have probably the most advanced technology in the history of humanity. And our financial service, I mean, COVID-19 mostly proved that the economy could even March with a huge part of the human population working from home. And this was partly because of our financial systems and the technology around that. But when it comes to risk management, we're going as well through a huge amount of risks related with, for instance, there's risk management associated to capital markets, but that's risk management in terms of cybersecurity. And of course, there's all the integration with the AI. I would say a lot of issues related with variations around identity and debt and a lot of different parts. So how do you see this risk management at large in the financial industry?
So let me first say that the one thing that kept the economy going is debt, because it increased the public debt to unprecedented amount beyond what was happening in financial services. But I think that risk management is the key perspective, and let's focus on one aspect of that, which is AI. In the global outlook for banking and financial markets 2024 that I published in January 2024 for the IBM Institute for Business Value, I said that as much as every banker is a risk manager, that's what banking CEOs were saying in the 1990s, because risk management is the core of banking, and not always they did risk management well. Going forward, every banker must be an AI risk manager, because this technology is probabilistic in nature, and it's not deterministic, which is a shift on how also the technology departments of financial institutions work, because in the past, technology was just collecting requirements and through deterministic technology trying to address and resolve those requirements. And the only space in banking where there were more probabilistic like analytics were the trading floor and the ivory tower of the risk management departments. But now this is what of data scientists and model developers within the CEO office that deal with the probabilistic analytics, which is exemplified by generative AI and then brought to on steroids by agentic AI. And they don't necessarily have the full experience that we've been building in the last 20 years through the financial crisis about what it means to risk manage probabilistic type of technology. So I was talking to the global CEO of a very large institution, one of the top 10 or top 5 in the world, some months ago. And at the question, what prevents your institution to scale AI enterprise-wide? His answer was crisp and clear. He said, the CRO, the chief risk officer, not because I don't like the guy, but because he says, I have like a variety of use cases for the application of AI in front of me. Some are live, some are ready to go. Many of them are multi-model between machine learning, generative AI, and quite a number of generative AI models deprecate fast. If you go to the IBM, the pages on the Watson X, you see statistics of how these models deprecate between 3 to 6 months. But it takes us, it goes something like 9 months to validate a model for risk management, and that doesn't necessarily mean that we have all the control functions in place. So the question is, how do we reorganize the way we work in terms of the platform for development and production and the competencies, the people, the organization that deal with that, in a way that we are more attuned with the life cycle of technology? Because the life cycle of technology is very fast. Deterministic technology sort of stays, but probabilistic technology changes. The model drifts. Just the fact that you validate a model doesn't mean that you own it in terms of risk management, because where you apply it might change the way the model behaves in the very end. So that's the reason why, for me, the secret sauce to scale AI enterprise-wide is to have a renewed interpretation of how to risk manage, these analytics, which is a change in the organization, as well as a reconsideration of the nature of the platforms that are used by the technology people to resolve the problem. And I give you just an example to ground it so that hopefully you understand this and the audience understand this clearly. Just imagine the investment management process. So it's based on narratives that defines basically the marketing campaigns. So the owner of the P&L learns that there's a new pope, and the pope lived in Peru. So I'm just giving a silly example, right? So he goes, I know that a lot of people will love to buy Peruvian stocks because, now they connect to an emotional element. So he has a morning meeting. He tells all the people in the various branches or people that talk to clients that that's a good story. People might be inclined to basically have that conversation. I know people are imperfect, but the system will adjust almost immediately. Okay, so the people talk to people in different ways. Now imagine that you use an agentic system end to end to deal with clients in terms of advisory processes, which is not yet the case, but just for your imagination. So when you change the strategy in front of a client, the business person will have to talk to a programmer. The programmer will have to understand business strategy. And then they will have to code it in the system to make sure that the system is drifted to correspond to business strategy. And then they have to test it. And then they have to promote it in production. It doesn't happen in half an hour. Today, definitely doesn't happen in half an hour. And by the time you do this today, the business strategy has changed. So all of these elements are those that prevent this connection between the two business people to own the technology element, or even to redefine how business people own the technology element in a way that they know that they can risk manage it and control it. Okay. And so the secret sauce here, the element that will enable that to happen is to embed the risk management perspective inside this system, so shifting left, making it breathe and live technically in a way that the business can deal with that under a control and protection framework.
It's so now I want to go through that and continue. One of the things that you've been doing is that you have as well been created. Well, you've been as well an entrepreneur and doing a lot of different things. So let's talk about CAPITECTS. Tell us about the company that you founded.
CAPITECTS was a joint venture created basically to outsource risk technology from a private bank in Germany, and then use those foundations to innovate in the wealth management space. And the reason is because as I worked in risk management for that long, when I saw the financial crisis coming and starting, I thought the economics of banking will be changed as a consequence of that. And that is particularly evident in Europe when interest rate became negative and the if you like fee business became more relevant to shape the annual report of many institutions on the continent. So that was basically the shift that I wanted to capture. And this shift is well explained by a paper of the European Central Bank that was published, I think it was like 4 or 5 years ago, no, 5 years ago, because I referenced it in the book, that is titled Financial Information and Technology, What's Old and What's New. So what the ECB says is that, in particular looking at European markets, but it applies everywhere in the world, banks exert market power if they excel in information and communication. So what is information? Information is the data inside the core banking system of an institution, which primarily comes from transactions, so payments, and the understanding of the adverse selection, so the credit function. And what ECB said at that time is that given the low or negative level of interest rates and the transformation of the economic conditions overall, the macroeconomic conditions around financial institutions, is becoming very arduous for banks to generate value for shareholders with the credit function, with information. So what I have to do, they said, is they have to open up, build like a banking as a service architecture to connect through APIs with open banking ecosystems made of fintech and other industries, basically to reach out to customers in different forms. Okay, they're not constrained in the way you use the information by relationships that are like tight around the core banking system and that perimeter. So you need to open the core banking to those open banking and open finance interactions. But at the same time, the ECB researchers recognize that communication is also important. And actually, communication is becoming, they said, more important than information to define the profitability of financial institutions. Now, Dinis, what is communication? Communication is me and you, is a human interface. Me talking to you on the symmetry of information that make believe I mentioned before, so that you make a financial decisions, through a conversation with me. And they say, how can you digitalize communication now? At the time, there was not even generative AI as a concept, right? So it was hard to understand how conversational banking could be effectively realized. So back in 2008, I thought that communication is the core of the wealth management perspective. So if I crack the code of that communication element, I crack the code of a new business model for financial institutions. So Capitex wanted to ultimately create a technical solution that would transform the way retail banks talk to retailers and affluent, as well as private bankers talk to the more wealthy individuals, by opening up the reference framework of quantitative finance in a way that people could talk to people based on more systematized elements, okay, of knowledge, in a way that they can be all helped to elevate themselves in a conversation systematically, because the problem is how you scale, okay, communication and conversation by keeping a good level of and a transparent level of that element of communication. And so that was the essence of Capitex.
So continuing on this, and you touched part of it, I want to go here. So one of your areas of research is regulatory frameworks, and this impacts finance. At the moment, we have different velocities in finance, and there's the innovation more part of finance, less innovation. There's Europe, there's US. Now we have a lot of different things as well when it comes to geopolitics that are actually the last couple of months are becoming more challenging. So how do you see the present regulatory frameworks like MiFID II and the impact in financial capital markets, and as well with everything happening?
So I had the opportunity of discussing with a lot of regulators worldwide, and also in particular, for example, even the European Commission, they invited me to present all my literature as one of their outing. Because the point is, first of all, we need to go back to the spirit of regulation, because I'm not sure that we are using regulation the right way. And that's not nobody's fault, right? But it's an understanding that regulators, policymakers, industry leaders need to have. So regulation has mimed the way the industry was created. The industry was created around the products, delivery mechanisms of products. So the regulation tried to follow those products. And somehow, even when now we touch technologies applied to specific elements, so that tends to follow those specific elements. But one thing I learned that the head of regulation of one of the European bodies discussed with me years ago is that maybe the regulation is asking the institutions the wrong question. So institutions will always be more dynamic and innovative than the regulators can be, by definition, because of budgets, right? Because of resources. And the fintech brought that on steroids, right? So change happens at the speed of light. But if you go back to when financial innovation was not about technology, but was about products and payoffs like securitization, complex derivatives. So the regulators were asking the industry to demonstrate that a product is adequate for a client. And as the products was changing, they had to refigure out how to basically create rules for that new product, the new specifics of financial innovation. And they were always lagging behind. But the real question that the regulators had to ask instead is different. The real question was simpler, though more hard, because simplicity sometimes is hard. The question would have been, can you demonstrate that the client understood what they're buying? Because it's not that Bitcoin is good or bad. In abstract terms, if you understand what it is and you want to play the game, just do it, right? But only if you understand what it is, right? You take your own risk consciously to put 100% of your money into that bet, right? So otherwise, you might just expose to fear of missing out. So the essence, the nature of regulation is basically when it's shaped to protect the consumer, is to make sure that everybody that is stronger in their relationship demonstrates that they are not abusing that fiduciary standard. So in the end, the client understands, right? And the problem of this understanding is that, because again, This is an industry where few people pretend to know too much about the future. They know nothing. While the majority of people think they don't know anything about the future, they should know to be cautious. So by starting from the fact that fundamental uncertainty is structure of the market, the bank will position the conversation with the client in a way that they are open to say, I really don't know anything about the future, but I'm here to talk to you and discuss so that we have a fair conversation about what can go on. And that repositions basically everything that happens in terms of the decision-making process of individuals and across ecosystems, the whole ecosystem interplay. So now, my work in research and regulation has been dictated by which are therefore these foundational elements that regulation has to remember in a way that they break the silos in which they confine themselves. And the silos is as such, there is always one client. That client gets a mortgage, that client invests in stocks, that client wants a crypto, the client needs an insurance contract. But we have a regulation for crypto, a regulation for insurance contracts, a regulation for mortgages, a regulation for ETF. And then we talk about client centricity. If the client is only one, so we really need to redesign regulation the ground up in a way that it corresponds to the scope that we want to basically fulfill in the transformation of financial services, bringing the client to the center while we keep on having the product to the center. I know that it's easier like that because you can more clearly identify the elements of control, but it defeats the purpose.
There's a lot of things there, and it's
Hey,
a key
Dinis, there are
element.
5 books and a lot of research.
I know. There's an area that I think now is being redesigned because of everything happening in the world economy, but I think that's another podcast on its own. So one of the things that I love from your book of 2021 is banks and fintech and platform economies, is the concept of platform economies. So I would like to elaborate this because I think this concept it's kind of not highlighted properly, especially on education and on business, because in the end of the day, we have, if you look at financial markets and the Magic Seven from Wall Street or from the capital markets, we have, for instance, Apple, Microsoft, Nvidia, and Google and Alphabet, and then all the other guys. We have more value almost in terms of economics than a huge part of the world economy. And they are platform economies in itself, but then there's the banks as platform economies, and there's all the digital part. So I know that your part here is about much bigger in terms of fintechs and so forth. So I would like for you to elaborate the platform economy from the book, but as well open it a bit more as my provocation here.
Okay, so the platform economy is evident. So Amazon is the platform or a marketplace that operates like, but there is a very big difference in the way platform economies work in financial services compared to how they would work in other parts of the economy like e-commerce. And my attempt has been basically to take a platform theory and mold it in a way that would be applicable to the transformation of financial services. And again, I needed the theory, the financial market transparency theory to do so. So essentially the FMT, which is the theoretical foundations of banks and fintech on platform economies, is theory of open banking, is theory of open ecosystems. So is theory of economic dynamics. Okay, and financial markets are a big piece of the economic dynamics. And then it's interesting that I launched the financial market transparency theory and principles in 2019 during the World Economic Forum in Davos, in one of the off Davos events. But the week before, I was invited to present the book in a conference in Hangzhou in China. The Hangzhou is the heaven on earth, as Marco Polo defined it. It's a wonderful lake, not as good as the Lake of Como, I would say. I'm Italian, but it's a very nice scenery. And I asked them, why did they invited me for that presentation. Now, one of my books is also translated in Chinese. I've been working with Chinese institutions since the 1999 in an assignment of the World Bank. So I wouldn't say I would know the market, but I'm known and I know the market. And they invited 20 people from around the world, architects, engineers, myself. And they said that China was at the beginning of the next year of opening, the next phase of opening up. The first 20 years were up to the WTO. The second 20 years were after the WTOs until 2019, 2020. And then now we're in the third phase. And they said that we're in the middle of the wars of capitalism and communism. And we need to redefine the value that underpins our economic, financial, and societal platform. And as my FMT is an axiology, talks about the definition of value, as say if you don't define value, you cannot digitalize value. We want to discuss that. Now, I don't know what happens afterwards because I don't speak Chinese, but I find that very interesting because they picked up the fact that you need to conceive the dynamics in the economy and in society really in platform terms. Society is a platform, politics is a platform, financial markets are a platform, right? The economy is a platform. In the Western world, that type of conversation happens less, I have to say. So people tend to be way more linear in their thinking, okay? Maybe it's the American way of doing the things. Now, I know the platforms, as I said, appeared in the world and they took everybody by surprise, social media, right, Amazon. But still, the conceptualization was lacking to understand how that really intersect the transformation of the economy. And I believe that it can happen through financial markets to bring us into a next level where we also address some of the deficiencies of capitalism that is now dominated by financialism, which is a problem by itself, right? So now the financial world is bigger than the real economy world, and that has unwanted consequences. So the banks and fintech competitive economy tries to basically connect these dots this way, understanding how using consequential statistics, which are regulatory driven, you can create positive network effects, elements that from the bottom up transform an whole ecosystem interplay. Now, it's difficult for anyone to change a complex system. You cannot do it top down by setting the rules because it can break the system. You cannot expect that this happens spontaneously from the bottom up because there are many constraints, which also regulation. So it's that balance, delicate balance between the reconceptualization of the role of regulation and policymakers in terms of transparency and the identification of those elements that allow the system to build through consequential statistics positive network effects that they change the way people sell to people, that transform the system, bringing it from one state into the other state. And as the core of this is the definition of value, my point is how can we build a value-based capitalism that allows people to position freely in the market while protecting the weakest link, which is the final retail client or the final consumer. And that in essence, okay, is what the banking fintech platform economy is looking at, contextual banking platform strategies and conscious banking platform strategies wants to achieve, or is my contribution to the challenge.
It's an important contribution, and more important than ever, I would say. So picking the next one. So one of the things that is quite unique on you, and I'll try to be synthetic on this, is that as a podcaster and as well as a researcher and as well a personality and speaker, you engage with a lot of authors and thought leaders. And at the same time, we are discussing the future of finance, fintech technologies, and what is critical around the divide financial innovation and traditional financial systems. I'd like to see from the discussions, from your own ideas and as well the discussions and conversations you have, how can we create a more inclusive financial systems that have, in the end of the day, all the innovation and all the tradition, and you work with a lot of banks as well. But one of the things I feel is the digital divide in terms of financial systems is still a lot. And we're talking geographic technological in a lot of levels. How do you see that?
Well, that's an important challenge. And I think that many have misunderstood the nature of that challenge. I'm always becoming a bit uncomfortable when I hear words like a democratization, okay, of financial services, because as I said before, the value needs to be defined. And the value is not about accessing investment opportunities. Because if you don't understand what you're doing, you create more damage than benefit. You just want to sell to more people. The challenge is how do you help people to understand what they have to do, okay, when they consume financial services, and then making it available to them through an element of understanding. So the definition of a platform is always about the elimination of a friction, okay? And when you eliminate the friction in the way two people interact, they are compelled to make that interaction with you instead of somebody else. So let me tell you how this works and how that reconciles. So in the banks and fintech cooperative economies, there are these two strategies on the bank innovation quadrant called contextual banking platform strategy and conscious banking platform strategy. What is the definition of contextual banking? Is the opportunity to eliminate the ecosystem friction, so to make things faster, okay, seamless, that makes banking contextualized. That means embedded, invisible, right? So being invisible, it means that you don't have to think about finance, right? Or to go to a bank to do a transaction. You can do it right there at the moment in time, right? The location of the need. And that is actually a consequence that by doing so, you create new value. When I say new value, I mean the value is not in the transactions because that commoditizes very fast. The value is at the level of the whole economic interplay. But clearly, when you eliminate one friction, you also eliminate a moment of thought. So it's not always good by itself. When it comes to payment, provided that you don't you start buying too much compared to what you own, which is a consequence of credit cards compared to cash, it maybe goes. But when it comes to credit, like buy now, pay later, we need to be very cautious because we're mixing convenience of payment with building debt. And that can be abused. As such, we saw that in some part of the world where these digital means were like more successful. What was thought to be inclusion became a trap of debt for many individuals. Now, on the other side, I have the conscious banking platform strategy, where I say it is the need to demonstrate value to clients, therefore to eliminate the knowledge friction. Just think about how you explain sustainability, okay, in a conversation with somebody else, which is a complex concept. It's not so simple as many think because you need to demonstrate impact. That makes banking conscious. That means transparent, okay? It's still visible, but it needs to be transparently visible. And that unlocks hidden value. What is hidden value? It's the value of the relationship. It is hidden by the fact that if you play the asymmetry of information in the make-believe that you know and the others don't know, while you really don't know about the future, you don't generate value. But being instead humble and sober to say, I also don't know about the future, but I'm here well structured to have a conversation with you so that together, right, we can take a conscious decision. And you really need to, apply yourself, and it's complex. That's why you need technology to do so, because it's not easy, that we generate value. So now these two elements at the end needs to intersect, right? So the eliminating the knowledge friction means adding more, right? Adding a conversation, which is a friction element of it's counterintuitive, but it is so that increases consciousness. Eliminating the ecosystem friction means that that needs to be accessible, right, at low cost for everyone. And so that is what happens at the intersection between the two. How do you use technology to basically make those elements of value more accessible? So in the end, by increasing the conscious element of an individual, and by doing that, so with seamless capabilities, you increase the conscious level of your ecosystem. Okay, and it may sound abstract, but in reality, has deep consequences because it changes the way we deal individually with the financial products and opportunities. It changes how we define goals individually as corporations, right? in the interplay of the ecosystem. So you really need, I do believe, this theoretical perspective, which is positive. That means that it can be realized in terms of business models where everybody has a benefit, the institution as well as the client, in order to change right, the whole system. And I do believe that as financialism is dominating capitalism, by addressing the way financial system work, will have as a consequence a spillover effect that will allow us to understand how the real economy needs to change also differently in the light of transparency.
100%. I think this is the key element, and that's actually the challenge. So my next question touches this. Okay, so at the moment, we have as well, for instance, I was in a conference recently with the director of MasterCard, and he mentioned that the crypto economy is around $11 trillion. So I would like to hear your views when it comes to this big elephant in the world economy and in the room, and as well how you see larger, of course, there's blockchain technologies, there's DeFi, decentralized finance, there's crypto, and there's digital assets. So from your research and literature, how do you see these both technologies and verticals and the impact that they have already in our world economy?
Okay, so crypto can bring opacity to steroids. Okay, it's not necessarily transparent, but is a growing field that also has element of value that need to be understood. What I'm concerned about is the fact that even in high-level fora where I meet bright researchers, there's too much discussion about the technicalities, being the blockchain or other elements, instead of discussing what does that mean in terms of monetary policies, the transformation of the economic system, the functioning of the banking sector, and how that intersects the need of the economy. So on the one side, talking too much technology means that people have lose gravity. They tend to over-engineer, right, the system. And when it's over-engineered, it always has a problem because over-engineered things are opaque and they at some point collapse. So resilience is an issue. And at the same time, there's not a sober discussion about what that means in terms of the functioning of financial markets and their interaction with human life and the economy. And I can tell you this in this form. There is a bigger elephant in the room that is built in the Bitcoin theory that nobody's ever discussing. I think that Satoshi Nakamoto, whomever he is or they are, was truly ingenious, right, in his definition. So he saw the Bitcoin, which is like when we talk crypto, in any case, we need to talk Bitcoin, okay, and then the rest. So he basically designed it in a way that is neither digital gold nor digital currency because it's both but at different times. Okay, so they cannot overlap because you need to go again to theory. You cannot ask yourself, is this or that? No, it's just like phased. Whether it will be successful or not, I don't know. But he said, using human greed, so the mining element is digital gold at the very beginning. So you're incentivized, right, to mine, right, for higher cost until that basically that is over. And then once it's all mined, how do you keep that value? Well, to keep that value, it needs to turn into a transactional mechanism. So the transactional cost needs to go down. So it starts to become an element of, a unit of exchange, so that it becomes basically money. But it needs to go into these two phases, right, which it takes very long time. It needs original conceptualization. But the end state that Satoshi discusses is kind of beautiful. So now you don't have a subjective monetary supply because the amount of bitcoins is basically capped and limited, and therefore you eliminate what you would have considered evil in the system, right? So the mechanism would be money is created between commercial banks and central banks. Okay, whether you believe is evil or not, but that's what he believed. And so automatically, excuse this word. It goes that the world will be a better world, right? Because we have a deflationary mechanism, right? That eliminates, right, the inflation element inside the economy and how that is created. However, there's a very big elephant in the room. You know that the first 1 million bitcoins were mined and nobody knows where they are. And you cannot disregard them because otherwise, you break the trust into the system. Now, that million corresponds to 1/20th of the 21, 22 million of Bitcoins that can be mined. And you know what is that ratio? If you go back to the 2008 and 10, that is exactly, to me, by chance, okay? There were at the time something like, if I'm not mistaken, 40 trillion worth of US denominated debt in the world. And the assets of the Federal Reserve were basically three, 2 to 3 trillion. So it's more or less the same percentage. So that means that in the end, even though you change the way the money supply works, there will be a lender of last resort. So it's not that it is a decentralized system because somebody owns 1 million of those Bitcoins. And in that conceptualization, that will become the new central bank. And you don't know who that central bank is. And nobody discusses that. So that's a fundamental discussion in terms of who will be the owner of the system, because as everybody will have a Bitcoin in that conceptualization, but one owns 1 million, 1/20th of that, which is the power of the Fed. Who is that lender of last resort that will dominate the system? That is a new slavery. Okay. So now, starting from that, then you can discuss the rest. But if this is not discussed, the rest is like, to me, greed. Okay, so opportunity to pump money and to take money out of the system. Nobody takes because we did not resolve and address the very theoretical foundations of this that has a strong impact in the function of the system thereafter.
I'm with you, and I think, of course, this is a Pandora box in a lot of ways, but as well the principles of especially DeFi and decentralized finance and the principles of cryptocurrencies and digital tokens was precisely to decentralize finance and create peer-to-peer economy. Of course, we know that it's much more complex than that.
And
but
it's not decentralized at all. Some platforms are dominating. Trading venues are concentrating. And so even in DeFi, there's nothing as DeFi because somebody owns a mechanism.
It's all about the platform. It's all about the platform. Yes. No, but I think the innovation around blockchain brought fantastic things. It's more about how we create, which is you touched before, how you create the transparency and how you create the rules.
But again, blockchain applied to the Bitcoin does not create transparency because in the end, there is a lender of last resort that nobody knows. And so there is an issue here. Then blockchain itself can generate transparency, but it's the application of technology that makes it very different, right? But not disentangling these two aspects clearly is damaging, okay?
No, I'm with you, and I think it depends how you. In the end of the day, it's not different from corruption in capital markets. How corruption in a system is depends on how you use the system. It's the same.
We move it around.
Yeah, completely. So I know I'm cautious of your time, so I have two more questions, and one that relates with financial markets and sustainability. So one of the challenges, of course, right now is being redesigned is how we integrate sustainable growth and the of course, ESG, environmental, social, and governance into the core strategies of financial markets and as well into our social economical models. So how do you see this precisely being as well part of one of the biggest leading tech companies in the world and at the same time as a researcher in the capital markets and as well as an expert?
Well, first of all, let's say that technology itself has a sustainability impact. And yes, you try to be net zero, but it will never be net zero, right? So you need to be aware about what you're doing. And funnily enough, as generative AI started dominating the headlines, somehow that we care a bit less, but these models are extremely, energy consuming, maybe more than the Bitcoin. So most likely when technology will improve through smaller models and open source, that will be diminished in essence, but still this is the case. But the big problem here is the definition of value again. It's not good to jump on the bandwagon of sustainability just because it's ethically sound to say I'm generated value in position with clients if you cannot demonstrate that. So it's the demonstration of impact that is the key element that tells the greenwashing from the reality. And how do you demonstrate impact? Well, you need to have data. And how can you have data? Well, you need to connect systems across different industries. And how can you do that? Well, you need to have standards for that communication to happen, and technology platforms for that data architecture to functions, and the elements of knowledge to be aggregated. Which means that it is the reconceptualization of information technology that will allow that to be realized or not. And somehow we are getting there, but we're not there yet, because theoretically we can get there, but practically there are different incentives in the system. So let me explain it this way. The history of information technology goes through three phases. In the 70s, information technology was small information, and big technology is hardware. Okay, so even the computer is sort of hardware, right, that you buy. But and hardware is pretty undifferentiated. It is true there are some servers that are better for some industry than others, right, according to utilization. But the differentiations, right, are minimal compared to what happens today with software. In the 80s, instead, software starts hitting the world. And that is when information and technology are at the same level. They're both capital. And software has the characteristic that is more personalized because it's used by an individual. There is a business person, okay, that defines their intention through the interface. And then is where the Moore of law that was dominating technology until it was information technology starts approaching a limit. At least we thought, at least a couple of years ago. And software is more complex to be predicted. So people that were working in information technology strategy were a little bit more, appended, because you don't have a law for software. You don't know when it's developed, when there is, how much that can be consumed. But the shift happened again in the 2000, 2010 in particular, after the affirmation of mobile technology and how cloud became the norm. Because now we went from information technology, when information is small, technology is big, information technology when they are all the same font, into information big, technology small, because it's about data. It's about information. So all is about that and how you share it. So it's about how you reconceptualize the architectures so that the data is portable, your systems are interoperable and compatible within institutions and across industries. And that I think also is what IBM has been understanding in terms of the shift in the world, the economic architectures of the world. But it takes a long time for that to be realized, which is limits also the capability of institutions to demonstrate impact on the sustainability aspect, because you will really need to be capable of interacting with very open ecosystem by bringing the data inside them. But that doesn't mean you cannot do that. If you do this selectively, right, by identifying those partners which are more capable and capable technically, and also in terms of understanding how they can use technology to build those elements of transparency that can be shared across institutions. That could be in the blockchain, for example, right? Where you connect the multiple industries or players in different industries across an ecosystem to basically make those elements of information more readily consumable and available in a certified way to demonstrate basically what happens out there. So that is where I do believe technology intersects the sustainability in the necessity to demonstrate impact and therefore value. Unfortunately, it doesn't mean that it has been realized, because doing so requires a governance of an ecosystem which intersects the human incentives and so on and so forth, right? They are not hard, they're hard to be realized, but that is where you basically connect the dots. Otherwise, it becomes, again, a compliance check, and that's not good, because value really needs to be generated.
Yeah, it's you put it in a very good way, is how we create the value out of it, and as well how we look at reality, because it's not easy, especially with all the geopolitics and even clarity around different protocols of looking at what means sustainability and all the models around that.
Well, I'm very liberal. I do believe that as long as you have a strong element of transparency, you let people decide And as some people decide one way or another, that has like a rippling effect. So nothing like this over impose goals. You need to allow people to position through communication, but that needs to be grounded, okay? And then things will happen. So as I said before, the top down and the bottom up needs to somehow meet in the middle ground.
100%. My last question, and it's been 1 hour and a half, so I want to respect your time. So you touch AI, but I want to go a bit deeper. So AI is taking the world by storm and is taking over our social, economic, financial models. There's a lot of discussions about creating potential universal income, future of work, jobs being replaced. So how do you see this impact in the social, economic, financial markets? And as well, what excites you about this potential future, and what are your fears or considerations, especially when it comes to future of fintech and banking over the next decade? And as well, any innovations or trends or concerns that you want to highlight to our audience?
So though I saw the rise of large language model coming, I was also taken by surprise by how fast that became. You know, how accelerated. We always talked about the exponential acceleration, but we really never saw it. And then all of a sudden it's there, right? And we see it. From a broader perspective, we need to be very sober and cautious about talking of artificial general intelligence, which cannot happen the way it has been discussed so far. There's a very nice book called Natural Intelligence versus Artificial Intelligence, which is a transcript of a seminar hosted by a bank in Italy that had Emanuele Severino, a defunct and very deep Italian philosopher, and Penrose, Nobel Prize in mathematics. They discuss that, and basically they go explaining that in the theory of consciousness, language is born out of consciousness, not the other way around. Because what is language essentially? Let me say it this way: is an element of lie. Okay, so as the human being realized that they were facing death, so they did a narrative in order to comfort themselves. I'm simplifying a bit, okay? And so language is there for us to tell us something. And language is imperfect because I can say, I love this class, or I can say, I love you. It's the same word, but it means very differently. But then if I say I love you, do you know if I really love you? Am I playing with the words? And is the meaning different in my mind, right? So it's very private. So now we start understanding that the quantum reality, right, which is about the privacy of the information, dominates the world, and language is imperfect to do that. So there's something else that basically shapes what happens in our soul that cannot be realized through language. So whatever I hear from Sam Altman or the likes, you will not create artificial general intelligence out of language as long as you don't start tricking, okay, and redefining the meaning of artificial general intelligence to seduce your benchmark, right? So if you lower the benchmark, then you say you got there, but really didn't get there because that's something else. Yet, we can power very powerful analytics that are, if you like, extraordinary in their capabilities. But again, it is their role to hallucinate because they don't know, they don't understand. And therefore, the risk management perspective is very important around that. So everything that goes around this aspect for me anyway is super interesting and is worth discussing, hoping to bring a substantiated, more reasonable voice in the battleground, to anchor everybody else too. Because if you're not anchored, you miss the value, and then you don't generate value, you can only generate trouble. But, and by the way, just let me say this, I defined the more reasonable biological macro foundations of financial markets being fundamental uncertainty, nobody knows the future, and the reversibility of time. time might not exist, so physics is now discussing that, but it's the epistemological criteria by which me and you make an interpretation of reality. That means life to death, the sense of purpose, and therefore goals. And that's exactly what finance tries to do, right? Enable you to position facing fundamental uncertainty, trying to achieve your personal or business goals in life. But at the same time, if you look at consciousness, not necessarily the origin of consciousness, that is highly debatable and discussed a topic, which is the hard truth of consciousness, the hard problem of consciousness. But the intensity of consciousness seems to be a function of basically fundamental uncertainty, okay? And our epigenetical understanding that we're about to die, we will have to die. About is not 80 years, 50 years, it's not a long time in the history of the universe. And so my research, which is another way of understanding my research in financial markets, is also a research around the conscious element. That's why I talk about conscious banking in the end, which is the real element of value, right? How can you relate finance to an element of consciousness? Because it's exactly the same elements that define the intensity of consciousness in the human beings compared to other species on the planet. But apart from that, I think the key element that I want to leave you with is the following. When Mario Draghi left the European Central Bank in 2019, 2 weeks before leaving office, he was commenting about negative interest rates and the fact that banks wanted to get positive rates. Like, as you saw, when rates go up, banks make money, right? When rates are down, they have a harder time in making money. But even though that happened now, the macroeconomic conditions are still very complex. So his comment back then still applies today, even though interest rate went up, might go down again. But the systems in terms of the credit space is very different now compared to what it was 20 years ago. Basically, he said that banks should not be concerned about the level of interest rates. So CEOs should not basically keep on tying themselves in terms of economic fate of their companies to the dynamics of the interest rates or dynamics of capital markets. Instead, banks need to adjust the business model to get the benefit of the digitalization of financial services. When central bankers talk every word's matter, they don't say lift and shift the business model, but figure out how to change the business model to get the benefit of digitalization of financial services. And I hear a lot of people talking about, that innovation breaks to business models. And then I ask them, which business models? And they have a hard time in explaining. So banks and fintech and platform economies are essentially being grounded on positive theory. The theory of financial market transparency discusses which are those emerging business models that correspond to a consistent and fruitful definition of value that allows an entire ecosystem to move forward, protecting the individual by giving benefit also to the intermediaries that need to be paid for that work. And that goes around the, if you like, convergence of contextual banking and conscious banking platform strategies. So I think that it is the understanding of these elements which is foundational, even more than what happens with technology, because once this is understood, the rest, with its own imperfections and exponential growth, will be more consequential.
Yeah, I love the way you touch the macro, and definitely, there's a lot of consequences, especially the way you're going to be seeing these things happening as we speak, because everything is happening in a very big velocity. One last touch on part, because you went macro. I would like to just go in a very precise question. I touched that in my question, but it was very broad. So if even with this kind of challenge with AI and all the things that you mentioned, do you see that potential we're going to have? Because in science fiction, we have two models, and science fiction has been for 100 years, of course, is science. There is a lot of fiction, but there's a lot of models that you can see. There's the model of, for instance, something like Star Trek, that you have a society that keeps going and all this innovation and creates still a very kind of, I would say, sustainable humanity. And there's a lot of other models in science fiction that takes us to a very dystopian model, like Blade Runner or other things. So what we need right now, and my question to you directly as a financial experts and technologist is, it's obvious that even with all the challenge of AI, it's already disrupting the entire world economy. And even, for instance, some of the researchers like Geoffrey Hinton are talking about potential massive risks, and there he's the godfather of AI. And we have a divided community of researchers, some of them talking about the massive risks, which I think is a huge part of that, that I'm as well on that part. And there's other researchers that see, okay, no, everything will be okay, we'll find a way. But at the same time, everyone agrees that definitely the work and the financial systems are going to be changed in the next 5-10 years like they were never. And we can eventually create even multiple layers of AI, kind of like we had the colonies, we have kind of countries that will be AI colonized. So these are the things that I would like to hear from you as the expert and as well the researcher in financial markets, because this is going to be, even for instance right now, if you look, like you touched, some of the unicorns in fintech are bigger than most of the traditional banks already, with some exceptions. So we have a lot of different things happening in a velocity that is still big, but we still didn't have any disruption as big as a lot of people can predict. But I would like to hear especially about universal income. How do we eventually see this? Because in the end of the COVID-19 partly did that in some parts of the world. Other parts, unfortunately, they had to adapt and do their best.
So it's my personal opinion, and he actually said precise, but it touched a lot of elements. I think that also the discussion about AI and universal income happens because we still plug this innovation within the faulted system that Alan Crispin admitted at the flaw in its model. And the consequence of applying all of this in a system that has a flaw at its foundations is that it becomes more and more exclusive instead of being inclusive. What has been happening even before technology became so dominant is that if you look at the distribution of wealth in the United States of America in the 1950s, the top 1%, the super rich, owned as much as the bottom 90%, which I think was something like 27% of that wealth. In the 1990s, that was very different. The top 1% owned much less, okay, just above 10%, and the bottom 90% owned a lot more than what they owned before. So that means that the American capitalism through production was becoming inclusive. But in the 2022, when I saw the latest statistic, was actually in the book of Ray Dalio, the distribution was exactly the same of the 1950s. So basically, we got back to where we started after the Second World War, which is the reason why we are so much troubled. Because even if a country grows 5% of GDP, but the growth is not distributed in terms of opportunity for the population, is that growth? Is that progress? So we're still measuring, if you know, knowing that the system is faulted, the success in the wrong way. And therefore, as we roll into this type of mechanics, when we apply technology, we risk of, if you like, accelerating that process instead of, using it to go somewhere else. So, but that goes again, how do we define the value of the economic platform where we want to apply these exponential technologies to, in a way that instead of giving up to the capability of the individuals to self-affirm themselves, just saying, okay, nobody's working, of course, we'll be like philosophers, get the basic income. We recreated the conditions by which people can re-participate into economic development, also reconnecting their own aspirations on their irreversible time, because if you eliminate the reversible time perspective on people, you don't have purpose, okay? So all of this is part of the way we try to survive, but also, build ethics that brings us together, right, in a sense of individual purpose, communitarian purpose, and so on and so forth. And so that is the reason why it's useless to discuss technology if we don't discuss before these technical elements that tend to be over-engineered, the foundations of our system. Because otherwise we over-engineer because we keep on trying the impossible, right? And we corner ourselves into a higher state of complexity. And I don't hear much about the discussion that is platform theory applied to, at the same time, financial markets, society, the economic model, that needs to be a common understanding, foundational starting point to make everything else, imperfect as it is, be capable of generating more value than damage. And again, value is not productivity per se if this gain is not distributed to the people, not by giving them back something out of the system, but allowing them to contribute to the system, right? And I know it's complex, and I know that it sounds a bit theoretical, but because again, if we now have nuclear plants and we will have a nuclear power which is more sustainable in the future, instead of using carbon to produce electricity, which still we use, is because we build theories that are capable of leading us there, right? Without good theories, we cannot grant technology for good, right? And use it. And so that's why I invite everyone to basically go back research and studying and to put this one at the center of the conversation, because that has to be the center of the conversation. The rest is interesting, is powerful, makes people excited because it's about becoming a billionaire, right? Or the market, but is a mirror, right? It's not the real discussion. And I don't hear this from policymakers, right? Big entrepreneurs or large conferences. I hear the usual talk, the talk of money, the talk of power, but not the talk of value.
That is the key element. And I think there's no business or any kind of economical society without value. In the end of the day, financial markets is about value creation and value conservation. So, well,
it should be. It should be.
It should be, and they have to be. So, Paolo is an honor, and there's a lot of stuff to digest. I think everyone listening to us, you are a super brain, but as well, you can actually go in so much levels, from philosophical to technical, and as well
wherever we start,
research.
Wherever we go to, we always landed to the same center point. That's why it's worth.
Amen. Well, grazie mille. It's been an honor to have you here, and I hope it's the principle of a couple more, and we probably will do some more interaction. The channel will have a lot of changes as we are growing. I wanted to do this for a long time. I did one long time ago. We're going to put all the information about you, all the books, all the information about the different people listening to us, whatever they're listening to us. And I'm very grateful to have you here. And I expect my audience to be excited and as well to work in some of the things and some of your provocations and some of the things that we have in your books, because we are all have to build this creation, this value. That
Let's make it a movement.
Thank you.
Arrivederci.